Okay, I'm going to let people in for another 30 seconds, and then we'll get started. Good morning and welcome to the ParkBridge Wealth Management Winter Webinar Series. This program is entitled Form 3520, Reporting Under the New Proposed Regulations. As always, my name is Jonathan Shenkman. I'm the President and Chief Investment Officer of ParkBridge Wealth Management. In that role, I serve in a fiduciary capacity to help my clients achieve their financial objectives. The goal of my programs is to bring professionals together to help them better serve their clients. And this is done by educating attendees on the latest topics in wealth planning and by encouraging collaboration between a client's attorney, CPA, and financial advisor where appropriate. My practice focuses on working with high net worth families, businesses, and not-for-profits. I manage individual investment accounts, investment portfolios, trust accounts, corporate retirement plans, and endowments to help my clients achieve their financial goals. In addition to the 20 or so events I run every year, I also do a fair amount of writing on the topics of investing and financial planning. You can read my work in a variety of periodicals, including Barron, CNBC, Forbes, Kiplinger, the Wall Street Journal, and Trust and Estates magazine, to name just a few. You can see all my work on my website at parkbridgewealth.com/articles or by following me on social media at Jonathan on Money. Additionally, you can check out my weekly podcast, which is also called Jonathan on Money, and you can listen to that on Apple, Spotify, or wherever you get your podcasts. Today, we're privileged to hear from Galia Antebi, member and head of Ruchelman Advisory, where she splits her time between New York and the Tel Aviv offices. Galia has advised U.S. and foreign clients on U.S. tax consequences of cross-border transactions for over 15 years. She advises non-U.S. clients on foreign investment or U.S. real estate, which often includes estate tax planning for clients that are foreign individuals. Galia has significant experience counseling high net worth individuals and multinational families with respect to wealth preservation, often focusing on the use of trusts. A significant part of her practice involves pre-immigration planning for non-U.S. individuals and expatriation planning for U.S. individuals. Furthermore, as technology companies realize large liquidity events in recent years, Galia developed a special understanding of equity-based compensation issues in cross-border settings, where she advises entrepreneurs on personal tax matters as they contemplate their compensation package or exit strategy. Today, Galia will be speaking on Form 3520, reporting under the proposed regulations. And with that introduction, I'll now turn the program over to Galia.
Thank you. Hi, good morning, everyone, and good afternoon if anyone is joining us from this neck of the woods. I'm in Tel Aviv today, and let's begin. So the new proposed regs didn't really add much, and I think that it's important to say that because often when you hear of new regs, you think that there will be new rules. Here, this is not really the case. It's really the 1996 regulation rules that become into regulations. So before 1996, we didn't really have distribution reporting from foreign trusts. We didn't have foreign gift reporting. All we had was the original 6048 code section that asked for reporting of US people transferring assets to foreign trusts. That is now not the case, and the rules as you know them is what we see in the proposed regs with some clarifications. So it's good and convenient reason for us to kind of recap when do we file Form 3520, because there are really three scenarios, right? There is the foreign gift, the distribution from foreign trusts, and these are not the same, although sometimes for tax purposes it might be the same, but for reporting purposes it is not. And the creation of a foreign trust. And when we need to do that, we need to understand who is a U.S. owner, who is a U.S. beneficiary, which sometimes would tell us who is an owner in return. We need to know what is a distribution. We need to know many things. So let's sort of jump in and start looking. And let me just see that I'm going the right way. Okay, so we'll start by looking really, if we're looking at the form 3520, we have actually the last part of it is the reporting of foreign gifts. And what's a foreign gift? It's a gift from a foreign person. A foreign person is really defined as someone who is not a US person. And when we look to the general definition of a US person, we look to 7701, and we see, for example, a green card holder. We see also people that are citizens clearly, and those who are present in the United States. We used to have a question that now the proposed regs clarifies. What do you do with a dual resident, someone who is a resident under this definition, but really not calculating his income tax obligation as a resident because they're taking a treaty position under the tiebreaker rules. We used to be asked that question as advisors and given what we thought was the right answer. And luckily now the proposed regs agree with us that we do not treat those persons as US persons. So you do have to report, right? It's a negative that is a positive on the question of having to report, because a gift from a dual resident will be a gift from a foreign person. Not all gifts are reported. We do report under the threshold. Now, the threshold started with $10,000 in the code, but very soon later, when the first notice with guidance instead of the regulations came out in 97, the IRS and Treasury decided that it makes sense to distinguish between gifts from individuals and gifts from foreign corporations and foreign partnerships. So for foreign corporations and partnerships, it stayed at $10,000. And it's linked to the cost of living. So by today, we're over $20,000. For individuals, they decided that it really makes more sense to make the threshold higher, and it's $100,000. And you do clearly aggregate. So when you count your 100,000, you count all the gifts from one person, and you also count from related persons. And so if you get, instead of getting 100,000 from only your brother, you'll be getting it from 5 of his children and few other people. You will have to aggregate all of those and count the 100,000. And when your gifts exceed it, you are going to report it. When you report, the current rules don't ask you who gave you the gift. They only ask you for the amount of the gift, some additional information like, let's say, the date, etc. But they don't ask you who gave it. One of the changes in the proposed regs is actually who is going to give it. The IRS doesn't think that it's a burden, which we all agree, because clearly you know the people who are gifting you money. Otherwise, they wouldn't really be gifting you. And you should know their status as foreign, again, in order to even decide if you need to report. So you have all the information already. It's not an added value, burden, I'm sorry. The 100,000 stayed 100,000 since 1997. It's almost 30 years. Didn't go up because it's not adjusted by the cost of living. But one of the proposed regs actually offers that it will be, so that can be nice when it will actually go a little bit higher. Penalties are quite great, and we're talking about 5% for each month, with a maximum of 25%. And that applies not only for failure like forever, but also when you file late. And we've had a client, because one of the questions that we always encounter is, when do you have to file, right? For example, a parent dies and lives, and yes, I'm sorry, I didn't say gifts also includes inheritance, bequests. And we had a client come and say that her father passed 2 years ago. She didn't get anything because there was a whole 2-year process of probate, litigation, whatever. When she actually got the property, she went to her accountant, told him about the property she received. He asked her about the date of death and reported the 3520 as a late 3520. 25% penalty was immediately imposed. a lot of money. I think it was $300,000. She came to us and we really decided to look more into that and check when do you have to file, when did you receive the inheritance. And this was an audit process, and we went and we spoke to the IRS, and the IRS agreed, specifically this agent, I can't say that it's always, but agreed with us that at the end of the probate, that was the right time to file, and so it really wasn't late. But the question will always come up, and one of the clarifying issues in the proposed regs also talk about the fact that you have a gift even if you don't treat it as a gift as the recipient, right? The recipient may say, this isn't a gift, this is a loan. So they're not filing 3520, but the IRS would treat it under all facts and circumstances as a gift. That means you have to file. And again, this is the question of when do you file that requires you to understand the transaction, if you had a gift and when was the gift. We spoke about the dual resident, and that, by the way, would also apply later. We'll see that with the case of distributions from trusts and transferring to a trust. I think we covered that, and with that, I will go to the next slide and go to the next obligation to report. So the next obligation is under section 6048. It actually encumbers three different requirements. It is the requirement to report the creation of a foreign trust and the transfer of properties to a trust, even if it is owned by someone else, right? We may have another person who is the owner and you're not the owner, and still you have to report. And when you create the foreign trust as well. That's under A. So 6048A is this report, and that too goes on your 3520 in one of the sections. I think it's part 1 that reports the transfers to a trust, regardless of foreign trust, regardless of it being you being an owner of that trust. We're looking at transfers that are gratuitous, right? The gifts to a trust. So when we have a transfer in return for consideration, that is fair market value consideration, we may not have income tax consequences, as we will later see under section 679. That may, and there is also 684, but these proposed regs don't talk about it, so it's not in our presentation. But we may have that issue kind of like saving us from having tax consequences, but that will not necessarily save us from the need to report. And I'm saying not necessarily because sometimes it is. And the distinction is whether you actually get something in return. When you make a transfer to a trust and you get something, you get cash, you get property, you get use of a property, anything that is real, a real consideration will actually exempt you from the need to transfer. But if what you get is an obligation, even if it's a qualified, the true obligation that will be paid, the IRS wants to know about it. So you have to report. And yes, you may be exempt from the income tax consequences of it. It may not make you a US owner, as we will later see, but it does go on your 3520. And yes, I see, I did mention here it's going on part 1, and part 2 is really the US owner, if I remember correctly. Then we have our proposed regs talking about what does it mean to transfer property to a trust. And transfer property is directly and indirectly, clearly, and also constructively. So we tie it to the regulations under 679 in understanding what it is. And we see that many more things than just a regular, straightforward transfer will be included, like an assumption of a loan, payment of a loan, guaranteeing a loan, transferring property to an entity that is owned by the trust, transferring property to from a foreign grantor trust to a non-grantor trust. These are all going to be have to be reported under under this code section in the 3520 of the US owner. Sometimes people confuse between 3520 and 3520A. because it's called a form for a foreign owner, a U.S. owner of a foreign trust. However, that form is an obligation that is under a different code section. It's the same 6048, but now we're under subsection B. And it's really an obligation of the owner to ensure that the trustee does it, right? It's the trust's form, and the owner only sort of steps in if the trustee doesn't do his job. And because the liability and the penalties are imposed on the owner. So 3520A is the form that will be reporting, I'm sorry, something got into my eye, will be reporting all of the accounting of the trust by the trustee. You have a balance sheet, you have everything. And then on top of that, there will be 3 statements. There will be a statement of all of the income that is allocated to our U.S. owner. And there will be statements on distributions and statements given to beneficiaries so that they can include it on their 3520. So again, everything here works together. The 3520 and 3520A, everything feeds into each other. So the 3520A is then going to be used by the owner and by the beneficiaries in their actual reporting. What I mentioned earlier is the need to have a U.S. owner sort of responsible, and if the trustee doesn't do his job, then we have the owner that will do sort of like a substitute form, and will do it to the best of his knowledge. And it's really recommended to have an agent in the U.S., someone that the IRS can speak to and ask more information. Because if they do, then they can speak to them, and less information will have to be submitted directly to sort of like the books and records wouldn't have to go directly to the IRS. But if you don't have a U.S. agent, then the IRS sort of needs to determine the amount of income and the tax treatment of the income, and therefore they will need access to the books and records, and it's just easier to have a U.S. agent instead. Going on to the last sort of filing obligation under the 3520, and that's the distributions. And I'll start by saying, again, earlier I said gifts and distributions are not the same, right? So when you get a distribution from a trust, even if you treat it as a gift from the grantor of the trust, because for example, many of my plans will have a U.S. beneficiary and a foreign father, mother, whatever, outside of the US. And one of the plans that can be really efficient from our perspective is to have a trust that is really for the benefit of our US person, but doesn't pay US taxes. So the parents will have, for example, a revocable trust, because having a foreign grantor trust for a foreign owner is more difficult than having a foreign grantor trust by a US owner. And so one of the 2 ways of having it, and really the only way of having it if your beneficiary is someone else, not the owner, is if it's revocable. So we'll have a revocable trust for a U.S. beneficiary, and clearly the tax consequence of distribution is like a gift. It's not going to be taxed to our beneficiary. However, it is still a distribution from a trust. So it doesn't benefit from the $100,000 threshold. And so any amount of distribution has to be reported. And it also goes on a different form. And it's not different form, I'm sorry, different part of the form. And the penalties are different, right? We'll see later, but I can already tell you the penalty for not filing distribution report is 35% of the amount of the distribution. We saw earlier that for a gift, the penalty was up to 25% of the gift. And so if it was really a distribution and you reported it incorrectly, you might have penalties, and that would be huge. So important to do that. Again, I think we talked about accumulation, or we didn't, but I'm sorry. The beneficiary gets their 3520 statement from the 3520A, the statements that would tell them about their distribution. Again, if it's an U.S. owner sort of trust, they may not have tax. But if it's unrelated to a U.S. owner type of trust, if it's like I mentioned earlier, a revocable from a foreign person or a non-grantor trust created by a foreign person, we may have accumulation distribution. You and I'm sure you all know what that is, and the throwback rules. So it's important to report everything correctly, and if it's not to the satisfactory of the IRS, they will have to again check all the books and records in order to determine the tax consequences. At the end of the day, we have to remember that all of this is done in order. It's a lot of reporting, but the reporting are there for the tax consequences essentially. And even though sometimes we may have an exception from an income tax perspective, like the qualified obligation we earlier talked about, when you have that, you don't have the exemption from filing, because the IRS wants to know, and yes, maybe we'll agree with you and will not have you have the tax consequences. We still want to know about everything. Going back to talking about distributions, again, we have to understand what is a distribution. So clearly, everything that is just a direct transfer of property, loans. We'll see more about loans and uncompensated use when we talk about the other code section that was subject to this proposed regs, but these are also treated as distributions. And that means that are reportable distributions. Distributions using an intermediary is an important one, because it also talks about the fact that yes, it's a distribution and you have to report it, but also goes to the question of when. When we have, again, someone who is an agent, and the agent of the trust, for example, let's think of an escrow account or attorney trust account, and the trust transfers the money there, and a year later it goes to the beneficiary. The beneficiary needs to report it when he gets the distribution. However, if we have someone who is not viewed as an agent for the trust, but viewed as an agent for the beneficiary that took the money for whatever reason, potentially assisting in income tax consequences to our U.S. beneficiary, then the right time to report is really when the intermediary, when the agent gets it. And for example, I see many clients asking me about, I have a non-grantor trust, I have throwback rules. Can I have my brother take the distribution and make the transfer a gift to me? I'll report the gift. Again, this is exactly what this comes to not allow, because the different tax consequences and the timing of the distribution and the report. We continue, again, I mentioned earlier, qualified obligations. Again, this is not an exception from the filing. We will see soon that it is an exception from tax treatment, because when we determine the need to file a report, one of the things we have to look at is what is a distribution. And as I mentioned earlier, getting a loan from a foreign trust might be a distribution. Getting to use property of the trust might be, without compensation, might be a distribution. And even if they're not, as we will see soon, because of compensation or qualified obligation treatment as compensation, they still should be reported. So I was just talking about the distributions being loans as well, and uncompensated use, and those have sometimes tax consequences. We can have beneficiaries getting those distributions, and that can be a taxable distribution to them if we're talking about a non-grantor foreign trust. That can be sometimes a distribution to them, not only for the reporting, but also, again, for tax purposes, even if they're not the recipient of the loan. If the recipient of the loan is a related person, it can still be taxable to them. And if the uncompensated use is not by them, that too can be something that they not only have to report, but also have to pay the tax on. We do have here the exception for qualified obligations. So if we receive a loan, but the beneficiary issued promissory note to repay, and that promissory note meets the obligation to be qualified obligation, which clearly is in the proposed regs, very detailed, very, very high level. It has to have a term of not more than 5 years. It has to have minimum AFR as an interest, maximum 130%. You have to extend the statute of limitations. You have to actually report the status of the obligation every year on your 3520. There is a question there on your obligations. They have to go there. If at any point, because the IRS does track your obligation, if at any point it is no longer a qualified obligation, then from that point on, your non-qualified is going to be treated as a distribution. And that amount will again potentially create tax consequences for you, may also make you a beneficiary, may make you a beneficiary, and if you are a US person, may make the US transferor to the foreign trust a US owner, right? I mean, think about it. You may have a US owner having a trust without any US beneficiaries, but the trusts end up making a loan to a US person that is related to the beneficiary, and all of a sudden that person might be treated as a US beneficiary, which makes the US owner a US owner and the trust as a grantor trust. That can happen. Clearly, we have to work through everything very carefully and see qualified obligations, not qualified, compensated, etc. But it's a risk, it's there. It can even be a loan includes when the trust guarantees the loan without a fee, right? When we plan for that and we use trusts to guarantee loans, we'll always have a fee so that it's fair market value. But if we don't, then it's similar to uncompensated use or to loans from the trust. We're looking at 2 years sort of. So if we have a person becoming a US person within 2 years of the loan or the use, that still counts for our distribution treatment. Next slide, sorry. I mentioned the exception, that is fine. We have a de minimis rule, 14 days. So if you think of an apartment in New York City, which some of my clients have held in trust, if it's a foreign trust and it's US beneficiaries, you have to make sure that no one uses, and when we say no one, you count everyone together, it's 14 days, but below 14 days, it's fine. Another exception would be anything that was already included in tax. So GILTI, Subpart F, etc., PFIC and QEF elections. If you have previously taxed earnings and profits, loan to an extent of those amounts will not be treated as a distribution. Now to what I think is, to me at least, the most interesting one, and that is Section 679, which is the code section that has US persons or a non-US person who becomes a US person within 5 years. And I have to say that I see that very, very often happen because I work a lot, as Jonathan was telling you, I'm based in Tel Aviv these days, and I work with a lot with founders of tech companies, and often they will move to the US, and sometimes their move might kind of be planned over several years. But if the 5-year is not met, meaning they move before 5 years is up, we may have issues with trusts that they've created for not necessarily US tax reasons, but the children would move with them. And with that, we will have all of a sudden a completely foreign trust that was completely legitimate, not any tax evasion, only wealth preservation, family confidentiality, whatever reasons. They now move to the US before 5 years are up, and we have ourselves a grantor trust. And it's not only US tax that we don't get to escape, it's also sometimes state tax in certain states, California, New York, Massachusetts as well, because I think they over $1 million, we go to 9%. It's a lot of money. So what is a U.S. person? Again, is someone is under the general definitions of U.S. person. And here we also have the distinction of dual resident if they're calculating their income tax liability under a treaty, a tiebreaker. They will not be considered U.S. persons, so they will not have all those consequences. But if they are going to be considered a U.S. person, and they need to be transferring assets to a foreign trust that has a U.S. beneficiary, right? If we don't have a U.S. beneficiary, yes, we do have to report it, as we talked about earlier, but we may not have the tax consequences. We may not be treated as a U.S. owner, meaning a grant or trust, so that we don't escape U.S. taxes on the income in the trust. And having a U.S. beneficiary is really a question of not just someone that is stated as a beneficiary, but someone that can have income paid or accumulated for them. And it's amazing to see, and the regulations existed for a while now. I think in 2001 they were issued, and now we only have proposed regs that add to it. It's amazing to see how it is all-inclusive. Everything is counted. If you have a grandmother as a beneficiary, but hey, she's a grandmother, and if she died, the only people who can inherit are U.S. people, you're considered to have a U.S. beneficiary. And there is generally, and I see our time is about to run, there is generally a presumption of a U.S. beneficiary. If a U.S. person transfers assets to a foreign trust, there is a presumption that there is a U.S. beneficiary. And what, unfortunately, the proposed regs make very clear is that you really shouldn't escape from reporting it and letting the IRS sort of exempt you. It's not that they have an action, it's you have to tell them how your trust doesn't. So you have to show them, you file a report, and you say, I've created a foreign trust, and there are no U.S. beneficiaries, and there are no terms outside of the terms of the agreements. There are no side letters. And if the grandmother dies, there are 5 children who are not U.S. people who are inheriting under her will before my child, who is a U.S. beneficiary, or not beneficiary, but who is a U.S. person, can get something, so that we show that it's remote. And you really have to persuade them that you are exempt, that you meet the requirements. You cannot just assume that you meet the requirements because you've done everything right, which is what I would love to have, but it's unfortunately doesn't seem to be the case. It seems that we have to report. And yes, we may not hear back from the IRS, but if we do, they might come back with more questions. And if they come back with more questions, we have about, I think, 60 days to answer, maybe 90 days. It's probably in one of those, 60 days, 90 days if you live outside the US to respond. And if you don't, that's it. It's presumed to have a U.S. beneficiary. So important to actually, especially if you are certain that you meet all the regulations and this trust is a good one, you shouldn't be the U.S. owner, then file, report, and let the IRS sort of not get back to you, and so that you will not have the tax consequences. Lastly, and I know it's time up, just the penalties. I mentioned earlier the distribution, and also the same penalty applies also to the creation of a trust, not reporting it, which I just recommended doing, right? So not reporting it comes with 35% penalty. We talked about the gifts having 25% penalties, and the trust's obligation to file the 3520A comes with a penalty for the U.S. owner, right? The trustee's obligation, it's the U.S. owner who has to make sure that it's met. And if they don't instead meet the obligation by giving you a substitute form, then they have the actual penalty of the 5%. And there is an additional $10,000 penalty for each 30 days on everything, not only on the 3520A, on everything, with a maximum penalty. How nice, for the full amount, right? The full amount of the distribution, the report, whatever the reporting was with respect to, if it's the transfer, if it's the distribution, if it's the corpus of the trust for the purposes of the 3520. This is our maximum. And there is also a minimum. So the minimum is $10,000, even if the IRS doesn't know anything about this trust. And maybe the trust is very small at this point when we didn't report, and maybe 5% or even 25% would be less. It's still a minimum penalty that is imposed. It's actually, I'm sorry, I said just now 25%. The 25% was for the gifts, which is under 6039F. Anything under 6048 is the 35%. So a minimum of $10,000. And I think joint returns, just one last point, penalties are jointly and severally, except if you can show that it's really one person's obligation. For example, his mother hates me, she wouldn't give me anything, it's his only, or whatever. So unless you can determine for the satisfaction of the IRS is that it's only one spouse's responsibility, it's a joint filer, joint responsibility. And that is it.
Great. Thank you so much, Galia, for that informative talk. If anybody has any follow-up questions or any other issues I'd like to discuss or any business opportunities, you can reach out directly to Galia or myself where appropriate. And I'm going to be sure to include her contact information in the follow-up email to this program. As I mentioned at the onset, the goal of these programs stay up to date on timely wealth management related topics and to collaborate where appropriate. And I think we can all agree that the clients who are best prepared are the ones who are served by a team of knowledgeable advisors. 3 more quick items before I let you go. First, my next webinar is on Thursday, March 20th at 8:30 a.m. featuring yours truly, Jonathan I. Shenkman of ParkBridge Wealth Management, where I'm going to discuss common mistakes wealthy families make with their money and strategies to avoid them. And I'll be sure to send out the invitation to this program in the coming days. In the meantime, I'd love to continue to grow this webinar community. So if you have a friend, colleague, or client who'd like to be notified of my upcoming webinars, they can email me with the word webinar in the subject line, and I'll add them to my webinar distribution list. My email is jonathan@parkbridgewealth.com. Second, you can follow all my work on X and Instagram at Jonathan Money, and by connecting with me on LinkedIn, you could also listen to my weekly podcast called Jonathan on Money, which is available on Apple, Spotify, or wherever you get your podcasts. And you can watch my practical planning videos, which I post several times a week, by following me on YouTube at Jonathan on Money as well. And third, please take 30 seconds to fill out my survey at the end of this program. It helps me improve my webinars and provide timely and interesting content to attendees. I thank you in advance for that. And with that, this concludes today's session. Please stay safe and healthy and have a wonderful day, everybody.
Bye.